uranium, oil, coal, natural gas. Now, which one of these energy commodities is the cheapest? We'll take a look at that in today's episode and more. But before we get started, though nothing in this video is financial advice, I'm not a financial advisor, so do your own due diligence. Your money, your responsibility. With that said, let's go ahead and dive into the charts. We have oil, uranium, coal, and natural gas prices stretching all the way back to March of 2020 here. We have oil in teal, we have natural gas in orange, we've got coal in yellow, and we've got uranium in blue. So far, at this very moment, uranium has been the highest performer, up 123%. Now, that is the commodities price. So it's sitting at 56.50. It's currently up 123% from the March 2020 lows. And now why am I choosing March 2020? Why am I not going further back? Well, March 2020, that was the beginnings of the lockdowns, and we had a reset period, as it were. Not the Great Reset, but we did have a reset of sorts. Stocks went all the way down, and commodities sort of corrected it at that point, kind of provided an equal playing field, an equal starting point, across the board. So that's why I'm using March of 2020 in this particular case. Now, the least performing sector is, at the very moment, natural gas, up only 34%. We've also got oil right above that at 53.65%. And then we've got coal up 107%. Now, if we're looking towards the most undervalued, we could look at it as our, which one has run up the ice. Sometimes people say, keep feeding your winners. So in this case, it would be uranium, but it might not be a bad idea as well to look into sprinkling in some capital for some of your underachievers, because they do have that explosive upside. So let's look at these different commodities one by one and compare them with all the others. So we're going to take things from the bottom here. We're going to start with natural gas. We're going to look at natural gas compared to oil. So this is natural gas priced in oil. And we've got this linear regression line juxtaposed here. Essentially, this is a best fit line. Across all the way from 1991. So we have long-term nat gas and oil prices here, which give us the privilege to really peel this onion all the way to its inner core. So this best fit line is essentially the mean of what we would consider to be kind of fair value. Okay. We've got this value here. It says 0.54. That's what you'd call an R-squared value. In linear regression, that value is kind of like a correlation coefficient, but it tells you how much of the variance is explained by this best fit line. So 54% of the variability is explained by this best fit line in this case. And what do we have here currently? We're currently sitting in this red zone for natural gas priced in oil. This tells us we're below the mean, okay? So natural gas priced in oil it's fairly close to the mean, but if you had to choose one, I would go with the fact that natural gas would be considered cheaper compared to oil. So that's one for natural gas. Now, let's look at a channel favorite, uranium. Now, we've applied the same linear regression line, and as you can see here, there really isn't that strong of a relationship in terms of directionality. This looks like a fairly flat best fit line here, but nonetheless, it looks slightly tilted up. And as we can tell here by the R-squared value, it's 0.08%, it would be considered 8.7% of the total variance would be explained by this best fit line. But nonetheless, natural gas priced in uranium is pretty cheap. It's all the way down here. It actually has been this low since 2012. Okay, barring a couple of months before here in 2023 as well. But natural gas is the cheapest compared to the uranium price, commodity price. Keep that in mind. We're not looking at the miners. Natural gas is cheaper than oil and is cheaper than uranium. Now, let's look at natural gas priced in coal. So natural gas has been underperforming coal. This is what this downward slope means, guys. So natural gas priced in coal, it is slightly beneath this mean value, this best fit line here. You've got an R-squared value of 62%, which is pretty good. 62% of the variability is explained by the trend here. And we are in the red zone as well. So what do we got? We've got natural gas cheaper than coal, it's cheaper than uranium, and it's cheaper than oil. So far, natural gas seems to be the cheapest out of all of these commodities. Okay, now let's go further down the list. Let's look at coal. More specifically, let's look at coal priced in oil. Now, coal has been outperforming oil over the course of a decade and a half now. But where is it cheap or expensive? The best fit line tells us we are currently below that best fit line, that mean, that average expected value. You're also looking at a 62% R-squared value, which is pretty good. 62% of the variability is explained by this trend line. And coal is cheaper than oil. It's cheap relative to oil, historically speaking. Now let's look at coal priced in uranium. Coal has been outperforming uranium now for a decade and a half. And we are currently cheap. We are currently in this red zone here in uranium, a 62% R-squared value. 62% of the variance is explained by this trend. Pretty discernible, a pretty clear uptrend here. And I mean, look at this upside here with coal relative to uranium. So we have coal cheaper than uranium. We have coal cheaper than oil. But it's not cheaper than natural gas. So the current rankings go natural gas and coal. Now, let's look at oil. Is oil, which one is cheaper, oil or uranium? These are the two remaining energy sectors we have left in our analysis. So we've got oil priced in uranium. And oil has also been outperforming uranium for quite a bit now. And we are in this red zone, guys. Oil is cheap compared to uranium. That's what the data is telling us. Now, the rankings seem to be rank number 1, natural gas. Rank number 2, coal. Rank number 3, oil. And then rank number 4, uranium. Now, those are the commodities. What about the companies? What about the equities? How do those kind of pan out? Well, let's kick things off on that front with the uranium miners, more specifically URA. And we've looked at this chart many times, but let's kind of take a look here at some of the recent developments in the uranium space. Actually, you can kind of adjust it here. We broke out, guys. I mean, I don't know how else to put it for you. This is a weekly candlestick view of URA, the uranium miners, and we finally broken out of this squeezing accumulation pattern, triangle pattern, whatever you want to call it. Okay? It is what it is. We've broken out of it. let's take a look at these candlesticks here. So for the last 1, 2, 3, 4, the 4 most recently completed weeks, we've closed the week with green candlesticks. Impressive. And so far as of this week, which is still incomplete, by the way, so we still have 2 more days worth of data to pipe into this thing. We're developing a bit of a hammer candlestick here, actually. I know it's red, right? But it's got this hammer candlestick, which means the buyers overpowered the sellers once the price plummeted down all the way to these levels. So far, so good when it comes to the uranium miners. And, if we kind of retrace this thing back to its highs, and we've looked at this before, we're looking at about a 5 to 6x. Okay, if we go back to these 2011 highs. Now, there's a lot more money in the system sloshing around than there was in 2011. So when you actually control for the money supply, i.e. M2, the picture gets even more bright, more glowing, let's say. To retrace back to those highs, you would need a 13x, guys. 13 to 14x. Incredible. Now, here is that same squeezing pattern juxtaposed here. And again, we see a breakout. Boom. Boom. We've broken out. Picture perfect. Textbook breakout. Now, OIH, the oil services ETF. This kind of proxies the oil equities in our case. And I mean, look at this thing. We've just been grinding on up higher. Looks like we're about to hit our heads on this resistance. Are we going to come back down and retest support like we've done for about 3 years now, since 2020? Leave me a comment below. Let me know what you think. But if we retrace all the way back to the highs here in 08, that would be a 4.5x. Okay? And similarly, if you control for the amount of money sloshing around in the system, that would increase to retrace back to those levels. You would see it. You would have to do a 12x. So similar upside to uranium in that regard, or at least the uranium miners. Now, natural gas equities. Now, one thing that is a real shame, and it's actually a positive indicator of the health of the market, is that we don't have any natural gas ETFs for natural gas producers. And there's a typical line of thinking that, when ETFs start sprouting out every other week or so, that's when you're at a top when it comes to a particular sector, because that's when the thing becomes popular. It's actually when ETFs start coming offline is when you probably want to get in, right? That's an indication of fear, of doubt, FUD. That's an indication of disinterest, dispassion in the market, and so forth, right? So we don't have, suffice to say, a natural gas ETF for the producers. So what I've done, I've created my own index here on TradingView. There's actually a script. You guys can do this too. Here, I'll show you. So if you go to your indicators here and you type in make an index, you can make your own index. You just click this thing here, and you can input it with the companies that you want to look at. So I've input this index with 5 natural gas companies. Now, I know I could do more, but studies have shown that 5 stocks typically are a good representation of the sector. That is, if you take a mix of 5 stocks, you're going to get that general kind of correlation with the sector. Okay, so I picked 5 natural gas producers, equally weighted. Okay, 20%, 20%, 20%, 20%, and I charted it out. So natural gas producers, this is where we're at. Sitting at this 25 unit level. And if we retrace back to these mid-2000 highs, you're looking about 164%. Okay, a little bit upside there. But if you control for the money supply, this tells a different story. Now, controlling for the money supply, i.e. dividing all these natural gas companies by the M2 in the denominator, you would need a 7.5x to retrace back to the '08 highs for these natural gas producers. Now, you guys can try it you can try it with your own basket of companies. Let me know in the comments below if you guys got any different results here, but this is what I got. Let's also do the same with coal. Now, there was a coal ETF a couple years ago called KOL, coal. And interestingly enough, it shut down right as the big coal bull market began. So, that's when I really began to, you hear these sayings, you understand them intellectually, but when you see it play out right before your eyes, that's when, it really hits close to home. So I did the same thing with coal. Actually, I think this is not the right one. All right, this is the right one. All right, so I did the same thing with coal, and there really doesn't seem to be much upside in terms of the coal basket here compared to some of its previous highs. So, if we do retrace back to these 2011 highs, you're looking at something around the ballpark of, or actually the recent highs, a 52 retracement. Now, all right, now if you control for the money supply with this basket of coal stocks, let's take a look at what that retracement would look like. If we retrace back to these highs, it's only a doubling. So what that's telling me, guys, is if you really want to swing for the fences, the uranium miners are probably your best bet. Either that or the oil services companies. They also have some pretty decent upsides, especially when you compare them with the money supply. Now, I think from a risk-averse perspective, the surest bet right now is probably the natural gas commodity, though. And the natural gas commodities, as well as the stocks, really aren't that. It's not that a big pill to swallow. These are kind of compared to the risk profile of uranium stocks, which don't have any cash flow to begin with. So they're by definition more risky. I mean, you look at stuff like Antero, you look at stuff like CNX. I mean, these guys all have like PE ratios of 4. I mean, these natural gas producers. And, they've already run up like 5, 6, 7x. But when you look at these charts, they still have a decent bit of upside to go. So that's where I'm at, guys. In terms of the raw commodity, I think natural gas and coal are the way to go. When it comes to the stocks, if you really want that upside, if risk is not an object, then the uranium stocks might be the way to go, even the oil services stocks. So those are kind of the two diametrically opposed insights that I've kind of taken away from this. Let me know in the comments what you think. Let me know if you played around with this create your own index script here on TradingView. And really interested to hear about your discoveries in there, guys. With that said, be sure to hit a like, hit the subscribe button, Comment down below if you haven't done so already, and I will see you in the next video. Bye, y'all.